Proudly brought to you by Investment Solutions with confidence.
The US Federal Reserve continues to spend $85 billion per month on its quantitative easing program. Although Ben Bernanke has hinted at the easing off of this spending, an elegant exit to the program as a whole remains elusive, and to gauge its success for the moment is premature. Aniket Shah is on the board of directors of Amnesty International USA. He's also a global strategist at Investec Asset Management. He says although the US economy is booming, there are pockets of the population who are not feeling or seeing any relief whatsoever. So, Aniket, you and your colleagues, bright young things, all got together on the Upper West Side a couple of weeks ago. What was that all about?
We got a group of people together just a few days ago to discuss the future of the American political system. Our political system in this country is completely broken. We had a president come to the White House in 2008, President Obama, bringing the ideas of change and hope, but as time went on, we realized it's much of the same. And it's not just the president's fault. We have a Congress that has 90% disapproval ratings, and our country has stopped being able to deal with big questions and big problems, whether it's fixing our economy, whether it's addressing climate change, addressing inequality, financial regulation. And the irony of all of this is that the American people want this change. It's there. The public opinion on these issues is there. But there is a transmission mechanism error from public opinion to the political system. So we brought a group of very talented political activists, scholars, business leaders, mostly on the young side, to start strategizing about a new political movement in this country.
So if the political economy is broken, the political system is broken, by definition then that is inextricably linked to the economy and the market. So they are being hamstrung by the very political discord that you've just spoken about.
The economy is in a very strange position right now because on the one hand, the financial economy is booming. You have stock markets at near or all-time highs. You have corporate profits that have once again reached historical levels. At the same time, the real economy is in the doldrums. We have unemployment and underemployment still at 15, 16%. Historically large numbers of folks who are long-term unemployed. And then, of course, a group of our country that we never talk about, which is the 15% of the United States who live in poverty, 1 in 7. So though the financial numbers are very exciting and investors are once again very excited about a resurging America, I think the more important question is, what America are we talking about? The America where we're sitting right now is thriving, that's for sure. The America that's on the cover of the Wall Street Journal is thriving. But there are entire segments of this population that have not participated at all in the recovery. And by the way, haven't participated in the growth of the last 40 years either. And we're starting to see in other countries around the world what happens when that actually goes unabated. What happened in Egypt, happened in Tunisia, what's happening in Turkey today, what's happening in Brazil today. This is not random. We need to figure this out. And the challenge, in my opinion, is these are structural problems. Structural problems of how an economy interacts with the rest of society, how an economy interacts with government. Who does an economy serve? These are very important questions that our political system and economic system does not want to deal with at all.
There are many who believe that QE has only benefited Wall Street, only the big banks, that it's only primary dealers that are really benefiting, not the man and woman on the street. Street's fine, of course, but Main Street isn't. Wall Street has seen the S&P and the Dow Jones go to all-time record highs this year, but we've still got 7.6% unemployment, as you mentioned. The ISM number, the measure of manufacturing in the United States, is mired below 50. Do you think that this is disturbing? In other words, the divergent performances between the markets and the macroeconomy?
You know, you have a segment of the population that's doing very well. If you go out to the Hamptons on the weekend, you wouldn't know that there were any problems going on in America. And the people who are in finance have benefited disproportionately. Look, the stock market is up very strongly from the lows of March of 2009. But the rest of the economy isn't doing that well. You know, the way I say it is Wall Street is thriving, but real people are suffering.
You talk about the efficiency of companies and record margins, but there is a sort of unhealthiness about that, I think, because the top line is not growing. In other words, revenue isn't growing fast enough, but the bottom line is.
Right, revenue increases are relatively modest, but profits are at an all-time high. And the labor percentage of increases is lower. Let me put it to you this way. Traditionally, in a recovery, sales increase exponentially. Labor compensation is usually second. In all the previous recessions, it's been second because the laid-off workers are hired back and the people who stuck it out during the recession are given bonuses or raises. Profits come third. Not so this time. This time, profits increased faster than sales. Why? Because the companies use the cash on their balance sheet to buy equipment to get the goods and services out the door with fewer workers. That had never happened before. That's why I say we had structural problems in the recession, and we're having structural problems in the recovery. And who's suffering? Labor is suffering.
Lee Adler, publisher of the Wall Street Examiner, says the Fed's policy is a series of long-term serial blunders. But because they take so long to play out, in normal human terms, we don't see them as blunders immediately.
Those of us that have some common sense might look at this and say, this is insane. They're trying to rig the markets and get a certain outcome from it. Normal people would look at it and see it as insane, but the policymakers are inside the bubble. They believe that what they're going to do will work. They believe in the theories. When it will stop working, that's a good question, and part of my job is to try to analyze the trend as it unfolds to see when the cracks are beginning to appear in the facade, where we might be getting to that point where things are going to come apart.
So again, I'm gleaning from you that this is very good for asset bubbles, very good for a very tiny percentage of the world, i.e. the masters of the financial services universe, but not that great for Main Street.
It's good for asset bubbles, and to the extent that 7% of the people hold all of the assets, as long as they manage to push the bubble up, it's good for the 7%. But everybody else is struggling because the corporate structures have learned that the way to increase profitability is to squeeze labor. There's no support for labor anymore. So the middle class basically is being decimated. It's disappearing. More and more people are falling out of the middle class and into the lower social strata. So their life becomes a matter of subsistence. They're not playing this game anymore. The policymakers are hoping that the 7% will spend so much money at Tiffany's and on their world trips, their world shopping trips, that they'll keep the game going and keep the masses employed at a subsistence level. But beyond that, how long they can keep the game going, I don't have that answer.
Decisions made by the US Federal Reserve have ripple effects across global economies. SA Reserve Bank Governor Gill says without functioning banking institutions, there simply cannot be a recovery.
Look, I think there's a question about the situation regarding banks generally. It's natural and I think quite appropriate reaction against the fact that banks have been supported at a time. But the question you have is if you don't have a functioning commercial banking sector, then you're unable to function anyway. If you looked at what's happened in the Eurozone And what was happening generally, even in the US, was banks weren't lending to each other. That's the situation that prevails in the Eurozone now. Eurozone is still in deep trouble because its systemic banking issues have not yet been addressed. And until you fix that, a lot of the other things don't work. So it's a hard pill to swallow that you have to support the people who got us into this mess in the first place. But you're not supporting those people, you're supporting institutions. And I think there's a very big difference. You really are there for the system, not the individual institution. The system has to function. If you do not have banks with confidence in lending to each other, they only function through the central bank, your system does not work. And even now, we're not out of those woods. So yes, I understand and fully appreciate the ordinary person's sense of, well, Wall Street is getting away with it again. But those are not the only measures. As I said, a lot of the measures that the central bank, certainly the US Fed, has taken has been in support of housing. So you're beginning to see a recovery in the housing market.
The widespread view of ordinary people is that Wall Street is getting away with it again. But a lot of the measures that the US Federal Reserve have taken have been in support of housing. And as a result, the housing market in the US is beginning to see a recovery.
The objective in any of these circumstances, because housing is the major asset that people have, is to try to support that. And that's been one of the, again, part of the measures that have been taken is to support gross fixed capital investment, which is the ability to look at your infrastructure, look at investment taking place, because there's certainty. I mean, what they've tried to do is create certainty for some time to come, that interest rates will be low, you can take the decisions. And I think that's extremely important. So I understand what the ordinary person feels about banks, but then again, there's other measures that are being taken through bodies such as the Financial Stability Board, which is part of the BIS G20 governors meetings, in which you're then looking at saying, what is it that needs to be done to better regulate, to ensure that there's much greater capital, that the banks are obliged to take other issues into consideration, including levels of pay, incentives, and so on. So there are other measures from a different angle that are being taken to try to better manage and regulate. And it's not just regulation, it's also supervision. A much more hands-on approach. So the sense of a light touch regulation, which was part of the thinking before, and which in South Africa we've never had. We've never had light touch regulation. We're a relatively intrusive regulator, and we certainly do supervise quite actively in that sense. But for those measures, it's a different leg of the same challenge of trying to address the issues, and therefore to try to better manage the roles of banks, as well as what is happening to a Main Street bank or High Street bank as distinct from an investment bank.
Coming up, the end of quantitative easing is looming. But what does that actually mean?
I think the markets will be in a tailspin for a while.
There will be consequences, including for countries like ourselves, as we've seen in many emerging markets, just at the reaction of the markets to his talk of tapering.